the good thing or the bad thing is that in this environment, to talk about how you should make money itself looks bad in some sense. But the good thing is that I can do it through Zoom,
Yeah.
and that makes it very convenient for me to participate from here.
Uh,
And therefore, it was much easier. So quickly, let me go to big picture. I will start with the, let's get the elephant out of the way, whether you should be in equities or not, and then I'll come to how to construct. Because for me, I've been quite good in terms of stock returns and all, but one part of that has been for anybody who's done well, whether you look at Rakesh Jhunjhunwala or anybody else, is because they believed in the concept of equity. If you believe that, you will not be shaken out of the market in bad times, and you will remember that you should add, average, whatever. But for that, you must first absorb the thing that equity itself is better than anything else that you can do in financial terms in with the alternatives that normally people have. So this is for the period of which for which I have been a fund manager. We started with the first fund in 1995, which was a balanced fund. But in 96, we had our first equity fund in the Alliance days. And so just to tell you, this is the return of the Indian market over this period. This is till March 31 of 2021, so very recent. And if you compare it to gold, for example, which is an easier thing to find, at least formal performance for, because real estate would be difficult to find in a neat form, which I can present to you, but it has significantly outperformed gold over this period in rupee terms. It has clearly outperformed fixed income investments over this period. But if you just quickly, one slide only on me, and then we'll go. If you look at my performance, which I'll tell you how we got it or what is a philosophy, but if you just look at the Alliance performance, plug in the Helios performance, the only thing is convert Helios into rupees. And actually, Helios fund is not even a long only fund, it's a long short fund. Then over the same period in which the market is up 221 times, the performance of a fund, or basically two funds put back to back, is 287 times. I'll cross this, but I don't want to overstress on this, and then I'll keep talking about this. So it is up 287 times, but this is after paying some 2% per annum, let's say, rack rate fee over these 24 years. Therefore, what I want to show you is that with the market up 20 times, even a diversified portfolio of 30, 35 stocks can go up nearly 400 times, as it has done for me pre any fee. But just to show how it can, this much can be extracted from the market, where actually the market does not have that many stocks that are up 400-500 times. And that is the whole story, and I'll come to it. But before that, when coming to the performance of equity over this period, people may say, oh, but right now there is COVID and there is lockdown fears, or lockdown has happened in some places, or slow this thing. But any of these events that you see, which we have seen from 1996, for the same 25-year period, any of them were significant at that time, worth at least a 10-15% drop in the market in those times. If you see, actually there was a 17% fall in a day in 2004. We have had Asian crisis, Russian crisis, global crisis, financial crisis. We've had bursting of the technology bubble, 9/11, November 26th, which by the way happens to be my birthday. And we've had billionaires getting arrested. We've had governments fall. The government lasted 13 days, which was Atal Bihari Vajpayee's government. We've had droughts, we've had wars, we've had this thing, and still the market goes up. This is not true only of India. This has nothing to do with the fact that India is a great country. It is to do with equity markets. I have written an article recently for Outlook magazine, which will come in their next issue. The same things happen in the US, in all countries, that the equity markets over time give much higher returns than others. And this is to be absorbed and accepted first before you say how to choose stocks, because it's part of this thing that I will change my shares, I will change my thing, I may sit on 10% cash, but I will not walk out of the equity market. In fact, I should average in those days, because if this is the return when there was a point-to-point return, that means you're just counting as if you invested in March 1996, and this is March 2021. But in between, whenever the markets fell 10%, 20%, 30%, if you had averaged, then your returns just arithmetically would be much higher than having just bought at one point and waiting for the other end. If we look at it another angle before I come to the actual philosophy and how to construct a portfolio, is look at it from a foreigner point of view who has many choices, and look at how foreigners have preferred India. This data is only since 2017, but broadly they have preferred India for a long, long time. But if you look at 2017 to now, if you can see in any of these years, say, let's look at 2020, which was last year. So India got FII flows of 23 billion, while the rest of emerging Asia lost basically $55 billion. So that the total is minus 32. That includes a plus 23 for India. You can look at 18, where basically totally 39 billion went out, but only 4 from India. And then in 17, which had 22 billion of inflows, 8 came to India. This does not include China, which itself is a very big number. But other than China, which for some reason is not easily captured in these data, whichever we find, it has always been like that. So now let's go to the actual part. How did this happen? Why do we like India? Why do I like equities? And more than that, that part is on how did I, because who knows, but this is how I think my philosophy developed over time, and it seems to have worked. So first thing which I learned early on in life is that because I read a lot, I found quickly that on every topic you can find a book. This is almost like Twitter, where you say anything and somebody will find a counterpoint. So for example, I tweeted today that Pfizer is a good vaccine, but then somebody will be able to find an article somewhere which says that Pfizer vaccine led to 2 deaths and 3 people having problems. So anything you can find a opposite view. And one part of investing is to sit back and say, is there an alternative view? Because you may read this book, which says the little book of value investing. And then it says Chris Brown is one of the best value investors in the world, said Mr. Barton Biggs. And you will read this book and say, I read this book on value investing, therefore I will do value investing all my life. And then you will find this book. This book is written by the same publisher, as you can see from the format, called Little Book. And it says a proven market beating formula for growth investing. And then there'll be a quote on the top that Navalier is an icon among growth investors. You will read this book, which says Benjamin Graham on value investing. And one of the luckiest events in my life was when I met Ben Graham, says Warren Buffett. And you will read this book and say, therefore, I have to do value investing. And you start writing essays, as some of our guys do. And then you'll find the same format, same style, Benjamin Graham and the power of growth stocks. You will find a book which says that crowds are mad, and that extraordinary popular delusions and the madness of crowds talks about the bubble in the olden days when the tulip bubbles and all these bubbles happened. And then you will find that in the world's 3rd or 4th largest company, Google, has basically been created on the concept of the wisdom of crowds. The whole point, as I will explain again and again, is that don't go by these one-liners for yourself and for your fund manager to tell you that there is a simple formula. There is no formula which says that beaten up stocks will do well, and there is no formula that quality stocks will do well. There is no that kind of a formula. I'll explain what according to us is the little bit of a formula. But let's look at these obvious things which we are told in this market, in the fund management industry by fund managers, or people themselves start believing. It's not that they're telling a story because they have read one side of the story or because they don't question things enough. They come up with these simple ones. This one is very, very common across the industry, that we buy stocks with high conviction, that we have 50-point checklist. We check those things and only then we buy a stock. And according to me, the simplest thing is that you don't buy things where you have high conviction. You only do things where you have low conviction. And the logic for that is as follows. Let us say you want to buy a house in Delhi, and somebody says, no, I've got a good house, big house for you in Faridabad or in Meerut. You say not interested. You are highly convinced that you don't want that. But if somebody says, okay, in Delhi, do you want GK or do you want Defense Colony? They will say, show me both and I will decide. You have no conviction. You will do analysis, you will do things, but the rejection will be down outright. Warren Buffett says, I don't buy tech stocks. Although now he's even bought Apple. But let's say he says, I don't buy technology stocks. That is his highest conviction. He does not say, I will first look at 50 years of annual reports, and then I will go and meet the director and board member and CEO, and I will discuss with my friend Bill Gates. He says, I am not interested, because he's highly convinced that it is not for him. These things are not just academic. We have to build it into our thinking on investments, which I'll come to on what we do. But the point is that what you buy, you have less conviction in than the things you don't do or don't buy, or girls you don't marry or boys you don't marry. You're more convinced about them because that is why you dropped them and moved on to the next guy. But where you wanted to marry, you said, no, let me do more investigation. Let me meet her parents. Let me meet her a third time. Let me go out with her to see whether we gel. But for the ones that didn't work, you said not interested and moved on. So you don't buy things with high conviction. You reject things with high conviction, and you buy things where you slowly get convinced. And that means that if you say that I have a 50-point checklist before I buy a stock, nobody's ever asked that fund manager except me, that what happened when you had checked only 48 items. You were not convinced that you still had to check 2 more items. That means you just wanted to cross a little bit of a hump of conviction before you buy. And that is a big difference, as I'll explain later. The other thing which, say, Mr. Buffett says, and in India, all the followers and blind followers and copycats say, that we should own stocks for the long term. Other than the tax angle, which in India itself is very low, it makes no sense to say it. You may own a stock for a long time, as I have done with many banks, private sector banks and all, but you don't have to say it. It's very simple. Let us say you are choosing from 500 stocks. In this case, it says 3,000, but let's say there are 500 stocks and you want to buy 20 stocks. Now, 1 year later, all these 500 stocks, their prices have gone up and down. The fundamentals have gone up and down. How is it possible, logically, that next year you've ended up buying or owning the same stocks only because last year you had chosen them, when over the 20 stocks themselves and the 480 you did not buy, there were positive developments and negative developments. There were positive stock prices and negative stock prices, so that maybe something which was the 21st stock last year suddenly has fallen 30%, but nothing else has changed. And therefore, that is the better stock. So to say it like this, that a fund manager should say to a new investor coming into, say, his PMS, that these are the 20 stocks for you. Because last year when I started my PMS, I had found these stocks for those guys. And that day I had committed that I own stocks for the long run and I don't churn and I buy right and sit tight. Therefore, today when you are coming in, I will just buy you the stocks that I bought a year ago. So it is just unrealistic to think like this. It also shows how blindly in India we copy some of these things. So for example, Warren Buffett and all these guys said low churn. And they said low churn because they have very high capital gains taxes, particularly Buffett, because he operates in a company and therefore he has to pay 30-35% tax as if it was a normal income tax. Like a normal income tax. In India, till 2 years ago, there was no capital gains tax if you had held the stock for 1 year. So there was no even a tax benefit to say that I have low churn, I don't rotate, I own them for long. It makes no sense. The only way it makes sense is that you are owning it, it continues to do well, you continue to own it. That does not make you a long-term investor. I have owned HDFC Bank for more than 25 years from its IPO day itself. But we never say that we have owned the stock as a long-term investor. The company delivers and we keep it. If the company was not to deliver, we are not going to give them 2 years' time saying we are long-term investors. So that is the way we look at it, because it is unrealistic for people coming at different times into a thing saying, no, but 3 years ago, this was my portfolio for those guys who bought our fund at that time, and therefore the same stocks are appropriate today. Another thing quickly on this, which in India, I'll give you some example, but basically, again, this is Warren Buffett kind of argument that as if you get only 20 chances, he just used that as a number, that there are only 20 chances you get to buy stocks, or you should act or feel that you have only 20 chances, so that you think before you buy any stock, which is fair. Obviously, you should think and research and analyze. But what did he himself do? So this is a paper which you can find on the net, written by three academics, these three fellows, John Hughes and whatever, and they analyzed 26 years of data for Warren Buffett or for Berkshire Hathaway. And these were, as you can imagine, his prime years in the 1980s and 90s, when he really created the outperformance that he's still running with. And they found that his own median holding period was only 1 year. If you look at Rakesh Jhunjhunwala has made his entire wealth for maybe 10 stocks. And the rest are stocks which he has bought. Some he may have traded, and then they worked for him, and some didn't work for him, and they broke even. But in the end, he had Titan, and maybe he had Crisil, or he had Lupin, or he had some whatever. And from those 7, 8, 5 stocks, out of maybe 100 stocks that he bought, he created his wealth. It was not that he started by buying only 20 stocks, knowing that which stock will do how well. These are all theories told only in hindsight. The other one, which is an easy one to sell to the public, to investors, we have some guys today who argue as if this is some great formula they have found, is buy companies with good management. But nobody has ever told them that when will you know that the management is good. Let us say Kotak, which is a broker, becomes a bank in 2003. So at which point did you realize that as a banker, it has good management? If you said it on day one, then it's just theory, because you don't know it has good management. If you say, I waited for one crisis, one cyclical upturn, downturn, and then I realized that they know how to allocate capital and how they are disciplined and how they don't cheat shareholders, you have wasted 8, 10 years before you would buy that stock. The beauty is that all these guys in India and in the world maybe say how this company has created wealth and that company has created wealth because it has good management, except that you would not have known it has good management from that day, because nobody knew that day whether Aditya Puri, who's just come from Citibank Malaysia, what was the claim to fame on that day, that I am in Citibank Malaysia, but turned out to be a great management. So we have to figure out how to deal with these things, because it's easy to say that we will buy good management. In most cases, by the time you're clear that the management is good, maybe the CEO is retiring. So what is management? In a multinational company, is the parents' management being considered, or the CEO's management being considered, or why is it that in Nestle, when the new Indian CEO came, the company has started doing well? That means previously the management was not great, because he was a Swiss guy who was not deeply interested in India, and maybe he took India as just a stepping stone as part of his global training and as he moves up the career path. Whereas for somebody, Indian guy who took it seriously and said that he wants to concentrate on India, and for him it was not just a posting as part of his international career. So what is management? And the second thing is, how will you separate the halo effect? Halo effect basically means that if a company is doing well, everybody assumes that the stock is doing that the management is good, which I will show you now. So this is an article in Fortune magazine in May 2000, in which the Fortune Cisco, this is from a book called The Halo Effect, this example. So Cisco was rated as the most admired company or whatever as per Fortune survey, and it was a bull market in technology. And they said, is John Chambers the world's best CEO? They run a tight ship, they're customer focused as much as you can see in anybody, and everybody flew coach. And then in 1 year, the stock price fell. And the same magazine, which had previously said this, and the price became 15, said, Cisco sales techniques have been irksome and have alienated customers. 1 year ago, they were saying, John Chambers is the most customer-focused human being you will ever meet. Acquisitions, forecasting, technology, all have failed Cisco because the stock price had fallen. Same thing you can see in India. Nobody ever tells you an example of a company that has a really bad stock price and people say it has excellent management. But look at it like this. We talk about fund managers trying to find good companies. Here, I'll give you examples about people who spend 5 years only trying to find good companies as a full-time 24-hour job, you can say, and how was their success. So this is a book called In Search of Excellence, which came in the 80s. I read it in the 80s. And so it must have come in 70 something because of the date that I can see here. So these guys from McKinsey Partners, and they wrote a book called In Search of Excellence. And when the book came out, which was in 1980, from 1980, they looked at the stock price for the next 10 years. And out of the 31 excellent companies that had been identified in that book, 13 of them only outperformed the index. Then there was this book called Built to Last. This is a more current book in the late 90s, I think. Oh, yeah, it says 91. So this book, they found these are academics who wrote a whole book on companies which are built to last and blah, blah, blah. Of course, of the 16 companies they found, only 6 outperformed the index over the next 10 years. But please look at the companies that they found. These are not some fund manager who's doing 20 things and has just said this company is good. These guys' whole project, the whole book, the whole academics is on trying to find companies built to last. And they found Citi, which is nearly gone in the global crisis and even now gone. They found Ford, which is more or less, less than one gaming company in India's market cap maybe. They found Ford. They found GE. They found HP. They found IBM. They found Motorola. None of these companies basically exist. They exist, some of them, but they're like nobody is interested in them. And then these guys did another book called Good to Great. And look at the companies they found as good to great. They found Circuit City, which I think is nearly bankrupt. Fannie Mae is gone. They found Pitney Bowes, which is gone. They found Walgreen, which is gone more or less. Just one of these retailers. They found Wells Fargo, which, as you know, has done miserably over the last 5-10 years. So the point is, even full-time guys couldn't find what is a good management. All these things we have to build into how to do things. It's not just to poke fun at others. The other one is that don't worry about valuations. If you're sure of growth, no problem. One day the growth itself will take care of the fact that you may have bought it high price. The normal answer will be, okay, if you paid 20% extra and therefore you're growing 20% per annum, so now you'll have 19 years of growth instead of 20 years of growth, and that's a great return. This is one of the most ridiculous things ever presented, as if you know that otherwise the company is growing for 20 years. If you saw the recent AGM of Berkshire, which was on this Saturday, Warren Buffett presented the top companies in the world in 1991 and then in 2021, and not a single company was repeated which was in the top in 1991, which also was there in 2021. But look at this study. So this is IBM versus Standard Oil, only compared for 53 years, not for 5 years and 2 years, but bloody 53 years. And over these 53 years, IBM grew its revenue 12% per annum and Standard Oil 8% per annum, and earnings per share 10.9% per annum and 7.4%. So it's a massive difference. If you were to compound this for 53 years, where IBM is compounding at near 11% and Standard Oil at 7.5%, and you can imagine the curve. And if you don't want to do it, you can check on your phone or whatever. And then how much did IBM outperform Standard Oil over this period? It underperformed. After compounding at a 3-4% higher rate for 53 years, it still underperformed what happened to Standard Oil. And look at it in India. So Infosys in 2000 had a valuation of 95 times. And for the next 5 years, its earnings grew 44% per annum. There's not a single company today which is trading at 70, 80 multiple that anybody thinks is going to grow its earnings at 45% per annum. And the Infosys stock price went from 139 rupees to 141, adjusted for the splits post that. So basically, Infosys did not move for 5 years. while its earnings grew 45% per annum. And then the same Infosys, in another phase of its life, which is from 2013 to 19, grew its earnings only 10% per annum. But look at the stock price. I mean, it didn't do great wonders, but it massively outperformed that because the PE was 15 when the whole story started. So this idea that it doesn't matter, that there are only 10 companies in this country and all that, I will show you all that makes no sense. But anyway, quickly, two more before we come to what is the way. So diversification is a protection against ignorance. If we know so much about these companies, if we are confident about these companies, why can't we buy more? Actually, this is Warren Buffett's line, and he has created, I think he has wasted so many investors' money with this line, because the fund manager can no longer be seen as saying that we are diversified, because the investor will say, but that means you are ignorant. You are not confident about what you do. And we say the following: A, that we don't know we are ignorant till something unexpected happens. And what if you don't know you are ignorant and are concentrated? You will blow up, as it has happened for hundreds of people in the world. And now let's look at it differently. Let's say that there are 100 investors in India out of whatever, how many million investors who are not ignorant, and therefore they are concentrated. Of course, in reality, there might be many more who think that they are not ignorant, but let's say that actually there are 100 investors who are not ignorant, and therefore they are legitimately concentrated. Now, unless you think that every one of them is going to buy Bajaj Finance and HDFC Bank, and so they will have identical portfolios, in which case it makes no sense. The reality is that these 100 investors will end up buying, even if there are 2-3 companies different and 7 companies are same, because they buy 10 companies each. That means broadly they are owning collectively some 150, 200 companies. Let us say 9 companies that they own are same as others, but one guy will have this, one guy will have that, one will have sugar, one will have metal, one will have bank. But all these 100 guys are not ignorant. So collectively they own some 200 companies. Now, if you go in and buy a 35, 40 companies, what harm have you done? Anyway, all those companies, somebody else who is not ignorant is owning in a concentrated way. The reality is that somebody will do well and somebody will do badly. Because if all do well, that means the whole market is doing well. But realistically, some will do well and some will do badly. And the guys who do well will think that they are heroes, and people will give them extra this thing. But in the end, that is just luck. That is not a strategy, because all cannot succeed in concentration. So it can't be the strategy which is good or bad. It is just that whoever found 5 good stocks and actually they were the best stocks, obviously he will do well. But there'll be some other guys who will find 5 bad stocks. So it's not the concentration that is the thing. It is okay if you find right stocks, I agree. But the reality from an investor point of view is that no investor has the courage or the guts to invest with only one concentrated fund manager. So in any case, the investor, if he buys 3 concentrated funds, he is not concentrated anymore. Therefore, this whole idea is illogical according to us. Quickly. Now let's talk about Buffett just for the sake of it, and then I'll quickly come. So this is my thing to say that how concentration has hurt Warren Buffett. So he bought Coca-Cola in 1988, and at that time it was one of his top holdings, and even now it is one of his top holdings. So we don't know exactly in which month of 1988 it was bought, but by December 1988 it was in his top holdings. So from that day to March 31, 2021, or maybe this is till December, let's see. Basically, the Coca-Cola stock is up 12.2% per annum, but Berkshire stock is up 14.4% per annum. Therefore, if he did not have Coke, his performance would be better, because Coke has done worse than Berkshire has done. Then he bought Wells Fargo in 1990. He sold it actually in 2020, but we are giving him credit as if he held it till the end of the year, because mostly the stocks were going up. But if you look at it like that, from 1990 to now, Wells Fargo underperformed Berkshire, which means Berkshire's other stocks did better than Wells Fargo for the whole company to be of 14%. And then he bought American Express And American Express is also, although very marginally, but it has underperformed Berkshire Hathaway. So actually, the top three holdings of Berkshire, if he did not have, he would have done better, which means his tail has done better. Now, of course, you can say he had Apple, but look at last year what happened. So last year in 2020, what we've taken is the portfolio that he had at the end of 2019, top holdings which are declared in the 2019 annual report, and just seen if he had held them till 2020 end, what would have been the return? The returns would have been better than the S&P, but he sold them during the year. Let's not give him that negative thing. But look at it. His Apple was up 82%, and therefore concentration helped. But just look at the performance of the second, third, fourth, fifth, sixth, seventh, eighth stock. All of them massively underperform the index. So if you believe that concentration means you know something, concentration means you are confident of something, nothing works like that. It is a lottery. In this case, Apple went up 82%. So it made up for all the other things. But I don't think that is what we mean when we say if you're concentrated, you are knowledgeable and you're not ignorant. That's all bull. Quickly. So what have we found in the last 25 years? Okay, let's ignore this slide for the moment. Okay, so our summary is that no one knows anything about anything beyond a point. And if anybody says that he has a formula or that he's overconfident, you know he's just trying to hard sell you. This I've already done. So let's go on. What we have learned. So first thing is be the casino, not the gambler. What does that mean? So we believe that you should own more stocks, that you should own 30 to 35 stocks. Even if you own 40 stocks, it's okay. Peter Lynch used to own more than 100 stocks and beat the market by 12, 13% per annum. Actually, you can easily beat the market with owning at least 50, 60 stocks. I'll show you. But anyway, we own 30, 35 stocks. And what do we mean by saying be the casino and not the gambler? Is that in a casino, there is a small advantage that the casino has over the gambler. And that is why the casino does not lose in the long term. Although in the short term, some gambler come and he wins on blackjack or he wins on roulette. But in the long term, because there's a statistical advantage to the casino wins because the game is played repeatedly. So for example, if you know the roulette, which has 36 numbers, and you get 36 times your money, the advantage to the casino is that actually there are not 36 numbers, there are 38 numbers, because there is a 0 and a double 0 and then 1 to 36. So there are 38 places where the ball can go, and you are going to get 36 times your money. So if 38 people were putting on all the 38 numbers, one guy will get 36 times and the casino will keep 2. And it is that small statistical advantage, which is why you can never beat the casino in the roulette. In the blackjack, it's a similar thing, that if you get more than 21, you are out. But what happens is if the dealer is serving, and you have got more than 21, the game is end, you have lost. They don't check whether the dealer also would have got more than 21, in which case he also would have been out, in which case it would be like a draw. But no, you have lost, you are out. So that small advantage makes it. So how do we do it in the stock market is that if you don't play the game repeatedly, you are gambling. Let's say that with our research and our model and some great insight, we have 2, 3, 4, 5% advantage over the stock market, in the sense that the stock market is just the index, which is nobody's analyzing at an index level. So these are the 100 stocks. And with your research, you can reject some stocks. And so your success rate in beating the index is like a few times, like 5, 7% higher rate than just the 50%. If you play the game only a few times, you can be a winner sometimes because by chance you bought some HDFC Bank in your life, but broadly it will not work. Your broadly to work if you bet more times and let the stats work, particularly in the long term. Now here it is. I'm just showing you that we have held HDFC Bank for 25 years. But does anybody really believe that I, in 1995, suddenly figured out that HDFC Bank is the biggest thing that I can own in my life? I bought 2% because it was, as I'll show you, there was nothing wrong with it. But who knew how well it'll do? And it's over maybe 10 years later that we would have bought more and added and made it 6% and 7%. But nobody knows these things to say like the way we do today, that if you bought HDFC Bank today, your last 20 years return would have been 20%. No, because you would not have bought it at that time. So we say that building a portfolio, and this is the real part now, you need to answer 4 questions. Which stocks to buy is obvious. The second is, what is your time horizon? Over what period will you own the stock? Or at least your research, and how many stocks to own at a time and when to sell. Quickly. So which stocks to buy? We say, like we were saying in the beginning, we don't know. We should start with what not to buy. So if there are 100 stocks in the universe, there are 2 ways of beating it. The market, which is the average of these 100 stocks, is to either buy 20 stocks or to not buy 20 stocks and buy 80 stocks. Now, we don't have to actually buy 80, I'm saying as a concept. And it is much, 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 much easier to say what not to buy than to say what to buy. It is like saying that an employee steals money, he's bad. But if employee does not steal money, we don't know what it means. If an employee works hard, he may be good, but he may not be good because he works hard, but he doesn't give output. Let's say an employee gives output. He may be good or he may not be good because he may be harassing women or he may be embezzling money. But if you say the other way around, he does not deliver results, he's bad. He harasses women, he's bad. He embezzles money, he's bad. So the bad's definition are very easy. There is no definition of good. The good is just that if you couldn't find anything bad, please give him benefit of doubt and do some more research if you want to. But broadly, don't think that you know what is good, because good comes with, there is no end. A company is good management, but does it have a long history for us to know? It has a long history, but is the price low or not low? But what if you just said, I will not buy the most expensive company one, I will not buy the most leveraged company one, I will not buy where the government interference is too high, I will not buy one company only, and you bought the balance 80 companies. Nearly every year of your life, you will beat the index. I have not beaten it every year, but at least 80, 85 times the time, 85% of the time, maybe 81, 82% of the time, by not trying to figure out what is good, but by trying to figure out what is bad. So we have this checklist on themes, and then on industry, then potential for disruption is a new factor, company management, corporate governance, financial analysis, and medium-term triggers and valuation. And you just remove. What you buy, you will have less conviction. What you will reject, you will have higher conviction. That is what I was saying in the beginning, that your conviction will not be that I am super confident on even HDFC Bank because there's just been a management change, but I'm very confident I don't want to buy some other things that I have not bought. Once in a while, mistakes will be made, of course, doesn't mean that everyone will work, but this formula works more consistently than trying to say, I have found a gold mine, because A, you haven't found it, it has been found, and now you are piling onto it, and nobody knows when those things will end. But that does not mean that we will not hold these for a long time as we continue to evaluate, but we will buy them with I'll show you that, sorry, next. So how many stocks to own? Now there's another theory which again Buffett and his chamchas have spread, that very, very few stocks do well, therefore you should own 10 stocks and 20 stocks. It is just mathematically not right that only 20 stocks can do well. Let's look at the S&P 500. There are 500 companies in the index. You have to beat the average return of that index, which must lie somewhere in the middle. It can never be the case that in an index of 500 companies, only 20 companies beat that average and 480 got beaten by the average, because the index is an average of these 500 companies only, the return of these 500 companies. So if you look at it, see year 2005, 245 out of the S&P 500 companies did better than the average, and the balance 255 did worse than the index. In 2006, 234 did better, blah, blah, blah. There cannot ever really be a year where only 20 companies will do well. So I don't even understand from where this theory comes that only 20 stocks will add value, because our first level is to beat the market. But let us say that in the US, in each of these years, which we have taken as the life of our own Helio Strategic Fund, that you could only buy with your great research, 150th best performing stock of that year. You could not buy the 10th best or the 20th best and the story spread by Buffett and brethren, but only the 150th stock each year. Or of course, if you had got something better, even better, but let's say the 150th, your return would have been 1830%, while the market is up 331%. If you do it for India, it will blow your mind off. We have only taken 300 companies. And again, we are looking at the 90th best stock, which is 30%. There we were taking 150 out of 500. Because India is very volatile. Suddenly you'll have a Dixon go up 300% in a year, which at the beginning of the year you may never have thought. But if you could only buy the 90th best stock of each year, you would have been up 57 times, 5,598% return versus the market up 8 times or 700% return. So the point is a large number of companies do well each year, 2 years, 3 years, 100 years, because it is arithmetic. It is not to do with our government or US taxes or US creativity. It is to do with arithmetic. That if you're calculating an average of 500 companies, the average return will be somewhere in the middle. It will be plus minus based on market cap and all. And therefore, if broadly speaking, 45-50% companies are going to be on one side of the index and 45-50 on the other, then 30% will beat that 45%. It is just arithmetic. And 20% will beat it even more. But there is no need to dream that I want the best company of India in terms of stock performance, because you have no idea which will be the best company for the next year. And therefore, you buy 30-35 companies and hope with your research, because you couldn't find anything bad in them, that some of them will turn out to be perfect in terms of some news or some short-term trigger. But when you went in, you did not have that idea. When we bought HDFC, we bought Bajaj Finance in 2011. And we sold it last year. But in 2011, you think anybody would have thought, including the management, that this will be a $35-40 billion company? No chance in hell that they also knew. So we say buy with a 1 to 3 year view. And if it does well, please continue to hold it. With a 1 to 3 year view, you can imagine that what can happen. You know, the management is the current management, the environment is the current environment, and the strategy is the current strategy. Long term, they themselves have no idea. Just one line on this, that Steve Jobs, when he died in 2011, 80% of his net worth was in shares of Walt Disney. And he must have no idea that Apple will be the biggest company in the world in 9 years. Otherwise, he should have moved his Disney shares into Apple. Bill Gates, out of his 125 billion net worth, less than $15 billion is in shares of Microsoft. He did not know that Microsoft is a better investment than everything that I'm diversifying into, because nobody knows. Nobody knows these things. You just broadly know that you're trying to do a good job, and then some will work and some won't work. So our portfolio construction thing is, quickly, this I've done. So let's say if I look at for the last 15 years, again, this life of our fund, HDFC Bank is up 23% per annum, but ICICI Bank is up 15% annum. So it looks a great idea that we had HDFC Bank as our top holding. So what great guys we are. But over the last 3 years or whatever, HDFC Bank is up only 12% per annum, but ICICI Bank is up 33% per annum. TCS, which also we've held for the longest possible time, is up some 23% per annum over this period. But you look at it over a shorter period, then in TCS is up 25% and India Mart is up 229%. And Dixon is up from 226%. We don't own India Mart now. We sold it in Feb. But I'm just saying that a portfolio cannot be frozen. The reason why we made whatever 300-400 pre-fee when the market is up 20 times is not because we bought stocks went up 400 times, but because in between many stocks went up like that and then didn't do well, like Z. In 1988 to 2000, it went up 100 times while I was holding it. And now it's maybe down from that period also. But at that time, we were not speculating. We were not saying that in 2020, this company will disappear, so I should not be owning in 1998. It was one of our 2-3% stock bets. Aban Lloyd went up 100 times very recently in 2004 to 8 or 7. We were not speculating that we know in the end this company is going bankrupt, so we shouldn't own it now. We were buying 2% at that time. It looked fair for a 2% bet, and it worked. In fact, Unitech, we made 5 times. The stock went up maybe 100 times between 2004 and 8. And we were not speculating that this guy is corrupt or this guy is going to go behind bars. So I should not be owning it. We were saying it's a real estate company, new sector, new thing. It has got a lot of land, blah, 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 buy 2%. So that is the game. The game is not to say I want a 100-year winner, because there is none. So we say portfolio construction, now I have to do it fast, should have two kinds of stocks. This is the final, let's leave it here, then questions, is that you need two kinds of stocks. One is where there is high confidence. But when you get high confidence, there is no return going to be made. It will be a reasonable return, which in today's context is HDFC Bank and Kotak Bank and TCS and Dr. Reddy and Bharti. It's not going to make you 30-40% return. It will make you 15-20%, whatever return, where there is confidence is there that the management is good now, that the history is good. Now we know that it is good, and so on and so forth. And then there is a second group where you could not find anything wrong, but you don't know. You don't know what will happen. This could be stocks that are suddenly down a lot, or stocks that are relatively new. And you say, I couldn't find anything wrong on those factors. It is not from a bad industry. It doesn't have bad management. It doesn't have bad history that we know. It doesn't have bad corporate governance as far as we know. But beyond that, who knows? It has reasonable, some triggers. And if it works, great. And if it doesn't work, it'll break even and we'll move on. And you buy 2, 3, or there are stocks that are down a lot. It could be some IndusInd Bank down 70% in 1 year, or Indian Hotel last year. And you say, now we don't know when will it recover, but it looks otherwise all right. But you are not going to buy it in a concentrated fund of 8-10%. But if you ask me to buy 2%, I'll buy it. And in that portfolio of 15-25 stocks, some will do very well, some will break even, and some you will lose. And that is how you will be there in all these things. So that is the whole idea, that you cannot do anything with super confidence, because super confidence, first of all, itself is a wrong thing. And when to sell quickly, there are many reasons to sell. But the practical one, I'm not talking about where the company is doing badly, it's okay, then obviously we'll sell, is where year after year the earnings growth is much less than the stock price movement, particularly in that first group of shares where the stocks was already well known. If the stock is a new discovery, like in our second group, then it will outperform the underlying earnings growth. But you can't have stocks where for 10 years the earnings growth is 15% and the stock price has gone up 25% per annum in a stock that was otherwise also well known. One good example of that could be Nestle, where for the last 10 years, the revenue growth is like 10%, and the profit growth is also some 9-10%, and your uh, earnings growth, stock price appreciation is 24-25%. It cannot work. It has not worked. And I can tell you 100 examples where it has not worked. Over time, you can't get all your returns from re-rating of a company that is already in the high confidence in reasonable return story, which is that anyway people know about it. It has to be a backbone kind of a stock, that it will do well in a good market and won't do badly in a bad market. But it is not supposed to give you that higher return coming solely from uh, higher and higher valuations for the same low or lower than market growth. So that's it. I think I'll stop here because I think my time may be running out. Let's go for questions, sir.
Sure. Thank you so much, Samir. The It was an extremely insightful and passionate presentation, I must say. So, audience, if you have any questions, please put it up on the ask question tab. In the speaker name, please mention the speaker's name so that it's easier for us to know you are addressing the questions to Samir. Okay, we have the first question here. So, Samir, what sort of risk control structures do you have in place to manage your funds investments during different market conditions?
So first of all, when we talk this from a foreigner point of view, we say we can't get away from the India risk or the currency risk. But at a portfolio level, the fact is, as I said, we are owning two kinds of stocks. Instead of letting the investor say that you choose one which is large cap and one which is mid cap or something like that, we are by buying 30, 35 stocks and limiting per name. So for us, the per name is that we cannot buy above 7.5% of the, not of the company but of our portfolio, and at 10% it must be reduced to 10. But I can tell you that in the last 16 years of running Helios, we have not even once let a stock go to 10%. So many people, these foreign guys would tell me that since you have so much experience, why are you not more concentrated? And the answer is because of that experience. So we have two levels of limit, one for the top 250 companies in India, where the limit is 7.5% and cannot go above 10% with appreciation. And for the smaller companies, cannot be more than 4% per name and cannot go above 6%. But again, we've never reached that limit. We are very happy with 2% positions in the smaller group and 4-5% position in the bigger group. The idea that if the stock is so good, how will it change your life if you only buy 2%, is because you don't know it is good, and forget about you, the management does not know. These stories that are sold now, I have lived through all of them, of owning HDFC Bank and Kotak Bank and TCS and all. The story told now is as if it was obvious. So let me tell you that in HDFC Bank, Aditya Puri himself, in a recent interview, said that when he joined, because he moved from Malaysia to India and all that, he wasn't sure of the bet. This is in an Economic Times interview. And he said that 2 years later, when they won some banking award, they celebrated in their office that they have now survived or something like that. So who, if they themselves thought like this, how would the outsider have come in and bought 10%? In Kotak, there was a recent well study of how much value Kotak has added in 25 years. But the reality is 25 years ago, it was not a bank. It was a broker. And who would have bought an Indian broker in the 90s? It became a bank in 2003. And therefore, in theory, if you wanted to analyze the bank and how it is done and how it has graduated from being a broker to a bank, you could not have bought it in 2004, 5, 6, or 7. So what is the point of saying to the world that if this bank had been around from, if this investment had been around from 96, this would have been the return? But we were living and we had it. We used to own 5% of Kotak in 2002 before it became a bank. And the total cost of that was $2.5 million for 5% of the whole bank. Its market cap was $50 million because you could buy this much only. You are supposed to bet 2-3% and then see how the managements do it. And that is how the risk control comes.
Sure. Moving on to the next question. If 50% of the companies outperform the index based on arithmetic, why is it that majority of fund managers still underperform the index? How
No,
does
first of all, 30 don't outperform. 40, 45 outperform, 55 underperform. 30, I was saying, is such a big difference from 40 that if we say in our mind that, because what we are trying to do is say, do you think we have a chance that our company is in the top 1/3 of India in terms of performance? Now, talking about this specific question, why fund managers underperform. So first thing is, if you look at the portfolios of these bigger companies, you will find that they own 400 companies, not in one fund, but across the firm of one. So I don't think there's a single stock that they have not bought. I am amazed at what kind of stocks there, but before that, it's again a mathematical thing. Ultimately, the market is made up of all these fund managers. There is no outsider. You can say there's retail, but then they also are part of their group. Basically, the fund managers are playing a zero-sum game relative to the index because all the fund managers together are the market. So again, like it is for stocks in a S&P index or in an Indian index, that broadly speaking, half will outperform and half will underperform. It's the same case for assets. Let's say it's for fund managers, although it's technically for assets. So let us say half outperform and half underperform. But now there is a cost. of the management, which is say 1.5%, 2%. Because of that 2%, instead of half beating and half beaten, some 35% will beat and 65 will be beaten, because some of them will come that they will beat an index if they had no fee, but they have a fee, therefore they. The next problem is that because these guys are, in my mind, concentrated, even if they have a lot of stocks, I'll explain, they will not beat the market every year. And therefore, over slightly longer period, in some years that guy's beaten, in some years this guy's beaten, and over time, some 25% guys will beat the market. Now, what I mean by concentrated is, you look at, I don't want to name because they are my friends and also at some level my competitors, but you see how aggressive views they take. So one of the biggest fund managers of India for 7 years said, I will only buy cyclical stocks and economy stocks and beaten up PSUs. And 7, 8, 10 years have passed with that strategy. We don't want that. When I was a mutual fund manager, and even now, we don't want that kind of an experience for the investor where you say, see, over 10 years, I beat the market. But actually, all your return came because you were waiting for your market and your strategy to be aligned. Because for 9 years, you were being beaten. And maybe in the 10th year, you beat the market so much that over the 10 years, you did better than the market. Because investors are not coming in with that view. They are all coming at different times in life. And that is what I meant with the other thing, that let us say I say I buy right and sit tight kind of an argument, that I never sell, I'm a long term, and for 10 years I will not sell a stock. So let us say I bought 10 stocks with 10% each. And because of the market, in 6 months, one stock became 12%, because it went up 20, 30, 40%, whatever. And the other one stock fell 5, 10%. So it became 9.5% or whatever. Now a new investor comes into our fund or into the PMS. Now, what am I supposed to do? For the new guy, will I buy 12% of that stock because the old guy has 12%? Or will I say, I will sell for the old guy because I want to give the new guy 10%? Or will I say, everybody's on his own. So after 1 year, some people have made a lot of money and some people have made no money and some people have lost money because of their this thing, even after they were all in the same strategy. So therefore, you have to manage so that you are giving everybody similar experience. And that is why it is fund management. The idea why I feel that many of these guys lose is because they think stock selection is fund management. Stock selection is one part of fund management. That's why I was telling you the other 3 things. How many should you own? For how long you should look? And when should you sell? Because sometimes you will sell only because for the new guy, you're not willing to buy that higher position. And if you feel uncomfortable buying it for the new guy, at some level, it means you are okay with selling it for the existing guy. And we have done it so many times. And over time, these things work out. Sometimes maybe holding the original stock would have been better, but over time, as a fund manager, you have to do many more things than just saying, I found this stock and I will never sell it kind of argument. But the fund management being beaten by the index is arithmetic, that they are the market. And then there is the friction of the management fee. And then there is a friction of consistency across time. If you take aggressive views, you are trying to match the market with you. And then for 5 years, the market will not be like you. And then you come back to your view, which is why the value guys don't buy growth and the growth guys don't buy value. And the high quality guys don't buy a small cap and the small cap guys I don't understand why they are so narrow that they can't analyze 2 different things in one fund.
Sure. So, audience will quickly take 2 or 3 more questions. I think we are running out of time. So, Samir, moving to the
I have enough time. If you don't have, then that's your fault.
Yeah, no, I think we can take 2, 3 questions because after that.
Yeah, please take. Yeah.
So I'll move on to the next question. Which sectors are you banking on or say avoiding, if that's easy, for the next 3 years? The horizon which you speak of in the PPT as well.
Yeah. So broadly speaking, we have themes we have chosen. I didn't show you because of time, but basically we broadly invest in 3 themes, which means 85% or so, because it's not that every stock in the country has to fit into my theme. But if it doesn't fit into the theme, it'll be harder to get into the portfolio. And the 3 themes are companies that compete with government companies, which these days primarily means financials, uh, which is private banks and insurance and all that. The second is urban or middle class underpenetrated consumer, not India underpenetrated, because everything, if you divide by 1.3 billion, we look underpenetrated. And the third is, which was originally IT and now expanded over the last 5-7 years to IT, no, pharma before that, IT, pharma, and specialty chemicals. These are the only three themes. If a stock is not in these three themes, like today we own State Bank and Bharti, then those together would be 10-12% of the portfolio, broadly speaking. Otherwise, 85-90% on theme ground would be in these three themes, nearly all our life, but never full commitment, because if we want to buy something else, we don't want to be embarrassed because the market is bigger than us. It is not I like these themes, so I will always buy these things. But realistically, these themes are most probable that you will find in our portfolio, and they have their own logic for doing well over time. And another way I look at it is that if you look at the Forbes billionaires list, all the top guys would be from these three themes. So I know that this is where wealth has been created in the very long term.
Sure. Question here. Do you employ any leverage to enhance your returns? If so, how much leverage do you generally use and how is it distributed across different positions?
No, we don't use leverage because in our long short fund, our net is only 60% average. So we are on average 100% long and 30-35% short. So it depends on what you call leverage. Some people will call our gross as leverage. And in our domestic fund, anyway, you're not allowed to use leverage. So basically, you can say no leverage, as in we are not having 100 rupees and having a 200 rupee exposure in the market. All those returns came without leverage. And in fact, not only without leverage, it came with a 60% exposure for the last 16 years.
Sure. Is there a particular niche of investors that you are aiming to attract for investments into your fund?
For the
would you like to
no,
comment on the profile of investors?
you know, one guy asked me that what kind of investors would you like? I said investors choose us. We don't choose our investors in that sense, because these are all liquid strategies. Even our offshore fund is liquid. Our previously, I was the number one biggest mutual fund manager in India. You could have as many redemptions, subscriptions. All that is part of it. That is why it is very different from individual investing, which is why I said there's a small fund manager role over and above stock picker.
Sure. So next question. If as you said, if nobody knows the damn thing about
Anything about
nobody
anything
knows
beyond a
damn thing
point.
without
Yeah.
index investing, wouldn't index
Sorry?
if nobody knows a damn thing, wouldn't index investing with smart beta strategies be a simple way to invest?
Well, smart beta investing could be for somebody. What I meant by that is that nobody knows anything about anything beyond a point, and therefore do not over believe in your knowledge to say I will own 5-10 stocks. We say, as I said, we are improving the odds like a casino. Now in the short term you could keep losing, but if you put very few bets, you could win also big, but you could lose big. We are saying that if the thesis is right, and unlike the market, I am not presented simulated performance or model performance or owning a portfolio now and saying, if I had it for 20 years, this would have been the performance. So, but broadly, it is true that for many people, it would be enough to own index. But this enhanced beta type things is again trying to be over smart. But we have done well for whatever reason. Now, as I said, even we don't know whether it was exactly these reasons which gave us this performance, but it is a bit different from the world. So we will always say active management, but we mean active management with us.
Any suggestions for a 20-year-old investor?
20-year investor has only one this thing: read all the books here and in my office. It is only reading which is the formula for an individual investor. See, if as a fund manager or as an institutional manager, we have a team, We have people who are attending calls, and we have people who are meeting companies, and I am meeting. None of that will be so easily available if you're an individual investor. And therefore, you have to read books to connect things across time and across countries. A lot of money we have saved or made simply by looking, because we also manage global funds and all, by looking at what is we are doing in the US fund. The same things happen with a 6-9 month lag. If those stocks are not doing well there, they will not do well here. You can do what you want. If they are doing well there, they may still not do well here because some of things are not available appropriate for example, cybersecurity. Very hot sector. We have a large exposure in our global fund. But when the Indian cybersecurity stock got listed a few years ago, there was no need to even look at it, according to us, because people can buy these things on net, online. They don't need a particular, it's like gaming. I mean, it makes no sense to say I'll buy an Indian gaming company, as if the Indian guy is restricted to buying some pathetic Indian game. He will buy a global game if he so desires, because he can do all these things online. So there are things like that which you have to connect. And that connection over time will come from uh, reading. What else will you say to an individual doing it on his own? So please read.